Tensions in the Middle East continue to ripple through financial markets, and investors are keeping a close eye on how it's playing out. To break it all down for us and explain what it means for New Zealand investors, we're joined by Fisher Funds Senior Portfolio Manager Robbie Urquhart. Robbie, good morning. Lovely to have you in the studio.
Good morning.
Let's start with the big picture. What is going on? What's the latest with how the market's reacting?
Yes, well, energy prices and oil in particular is the key connection between the conflict in Iran and financial markets, and energy prices have been pretty volatile as a consequence of the war. So oil is currently trading at around $108 a barrel, which is up substantially from $70 prior to the war starting. That's resulted in financial markets selling off some, so we've seen government bond yields across the globe edge higher as investors fret about the inflationary consequences of energy prices going up. And we've also seen share markets sell off. So the US share market is off about 4% since the start of the war. And other markets are off a bit more. European and Asian indices are off somewhere between 5 to 8, 9%, depending on the market. And the key thing that investors are really focused on at the moment is the Straits of Hormuz. That's a narrow stretch of water that abuts Iran, and it's a passage of water through which about 20 to 30% of the world's global oil and natural gas supplies are transported. So while that effectively remains shut at the moment, that's obviously putting pressure on energy supplies and pricing, and that's what everybody's focused on.
The longer this drags on, are we looking at potentially having a situation like in the 1970s with the oil shock, where the markets really suffered there?
Yes, well, if energy prices do remain elevated and the Straits of Hormuz are not opened, we could end up with a 1970s style drag on economic activity. But there are also good reasons to believe that even if oil prices and energy prices remain high, that we won't necessarily have that stagflationary environment that we had then. The world economy is quite differently structured today compared to the 70s. And if we think of the US in particular, which is the biggest cog in global financial markets, the US economy is much less energy intensive today per unit of GDP produced compared to the 70s. And the US is also a net exporter of energy today, whereas it was a net importer of energy back then. So there are some buffers there that is quite supportive for the US and the global economy's ability to withstand this oil price shock. And I think that's one of the reasons why we've seen the US share market hold up as well as it has under the circumstances.
When you've got stagflation, what does that mean?
Stagflation is just the economic scenario or environment in which inflation is high, but economic growth is sluggish or stagnant. So back in the 70s, businesses would see their input costs go up, but their sales wouldn't grow. And that's a pretty awful cocktail if you're trying to grow profits and grow an economy. Is
that something we could potentially see here in New Zealand?
Well, I think it's too soon to tell in New Zealand whether we will end up in a stagflationary environment. Right now, our government is pretty focused on ensuring that we have security of supply, that we get the quantity of refined fuels that we need imported into the country. Because unlike other countries, we are very reliant on imports for our fuel security, so they're rightfully focused on that. So we'll have to see how this plays out. I think the other interesting thing, though, is how policymakers and central banks in particular respond to this environment. Because if you think about that stagflationary scenario, they got to weigh up the impact of higher energy prices on rising inflation, which banks don't like, against the idea that if you raise interest rates, you could crimp economic growth and exacerbate that.
Yeah, so much volatility at the moment, right? Well, I mean, what is the advice to, perhaps not advice, but what should investors be looking to do? Is it a case of sitting tight, or trying to deal with that kind of environment?
Yeah, I think it's important for investors to remain measured in this environment. Things could change quite rapidly for the better as well. In which case, if the straits are opened, you could see a relief rally across markets. So if you've got a portfolio that's got a good mix of assets, shares, bonds, and so on in it, it's probably good to just stay the course. But if this volatility across markets is keeping you up at night, it's probably a good sign that you should reach out to a financial advisor and check that your mix of assets is right for you.
Fisher Funds, Robbie Urquhart, thank you so much for coming into the studio this morning.
Thank you very much.
It is